Bismillah ar-Rahman ar-Rahim. Assalamu alaikum rahmatullah. In this video, I'm going to discuss the topics included in chapter 4, which focus and revolves around interest rates and how we calculate them. And it will also introduce one of the popular over-the-counter interest rate derivatives, which is forward rate agreements. Forward rate agreements are important derivatives, and it's also an important topic because it introduces us to interest rate swaps, which we will learn in chapter 7. Okay, so to start, let's remind ourselves with what is an interest rate. Now, when you hear the term interest rate, what does come to your mind? Basically, it is the rate that defines the amount of money a borrower promises to pay to the lender in exchange of taking money from the lender and returning it back sometime in the future. So 10% means that if the borrower borrowed 1,000 from the lender and promised to return it back the principal amount and the interest after 1 year. So after 1 year, the borrower will pay back the lender 1,000 the principal plus 100, which is the interest. Now, what is the relationship between interest rates and credit risk? And before we discuss the relation between interest rates and credit risk, let's remind ourselves, what is a credit risk? The credit risk is the risk that the borrower will not be able to pay back the interest, or will not be able to return or pay back the principal amount. So the credit risk doesn't come only from the fact that the borrower might not only be able to pay back the principal. Also, there is a credit risk if, or there is a default event if the borrower was not able to return back or pay back some of the interest he is obliged to pay. Now, as the credit risk increase, what do you think will happen to the interest rate? Do you think it will increase or decrease? Logically speaking, the riskier the borrower, the higher the interest rate that will be required to lend that borrower. So there is a positive relationship between interest rates and credit risk. Now, usually in the financial press, interest rates are expressed in basis points. So what do we mean by basis points? Now, a basis point is basically 0.0001, or it is 0.01%. So when you hear, for example, that the Fed has increased interest rates by 25 basis points, this means what? They increased interest rates by how much? So 25 basis points is basically 0.0025 or 0.25%. Now, this is extremely important to master and make sure that you understand and you know what the basis point is, because whenever we are dealing with interest rates or interest rate swaps, we will be relying on this because this is what is used in the industry. Now, we turn next to the several types of interest rates. So in general, there are four major types of interest rates that include treasury rates, LIBOR or CIBOR or Euribor or whatever is similar in terms of structure to the LIBOR. And there is the federal fund rate, or sometimes called overnight rate. And finally, there is the repurchase rate, or the repo for short, repo rate. And we will discuss them in detail. Okay, let's start with treasury rates. So treasury rates are the rates earned on instruments issued by a government on its own currency. So usually these rates only we observe in instruments or debt instruments issued by the government. Now, how can you earn this rate? If you want to earn, let's say the treasury rate you observed in the financial press is 1.5%. How can you earn this rate? Well, it depends on the treasury bill or treasury note or treasury bond that provides this rate. Now, every government or most governments, they issue instruments, debt instruments, from time to time. For example, in the US, the issuance of treasury bonds or treasury bills or treasury notes are on a daily basis. Here in Saudi Arabia, the government doesn't issue treasury instruments on a daily basis, but they provide a plan to describe or to state when does the government plan to issue new instruments, and the entity that is responsible for managing the debt issuance by the government is the National Debt Management. Just to share with you their website. So this is the National Debt Management Center, and they are responsible for the issuance of a variety of debt instruments to the benefit of the government. Okay. Now, what do you think is the risk level of treasury rates? To answer this question, think of the following. Is it possible for a government to default on debt issued on its own currency? Is it possible that a government will not be able to pay back a loan issued on its own currency? Well, the answer is no. Why? Because simply the government can print new cash and use it to pay back its loan. So if that is the case, what is the risk level of treasury instruments? Well, it's risk-free. It is impossible for a government to default on debt instruments or debt issues or debt obligations issued at its own currency. Now, if the government issued debt instruments based on a foreign currency, that's a different issue, because it might not have enough reserves to of the foreign currency to pay back its foreign loan. Then in that case, it is possible that a government will default on its debt if it was issued in a foreign currency. But in its own currency, no, that's not possible. Okay, The next rate is the LIBOR, and the LIBOR is the rate of interest at which a AA bank or company can borrow money on an unsecured basis from another bank. Now, before we proceed, do you think that the AA is the best or the highest credit quality? Well, the answer is no. If you look at S&P, for example, credit ratings, you will find that the best rating, or the highest credit rating, is the AAA, AAA. So here you can see that the LIBOR is based on a AA a borrowing done by a AA company or bank. Now, currently, the LIBOR is available only for 5 currencies and for up to 7 maturities. In the past, the LIBOR was available for 10 currencies and 15 currencies. But after 2008, there was 2007, 2008, there was allegations that the LIBOR rate was manipulated. We will see as you can see here, now there are only LIBOR rates for 5 currencies and for 7 maturities. As I said, the LIBOR was available for 10 currencies and 15 maturities, and because of the amount of data on all these currencies and maturities was not easy to monitor, there has been pressure by regulators to reduce the number of currencies on which a LIBOR is issued and the range of maturities. So you can see here that there is, let's look at the US LIBOR. So in the US, and this was for fixings on February 10th. There is a LIBOR rate for lending overnight. There is a LIBOR rate for a 1 week lending. There is a LIBOR for a 1 month, 2 months, 3 months, 6 months, and 12 months. So these calculated on a daily basis. Now, how the LIBOR is calculated, the British Bankers Association gets or asks for submissions from around 18 global banks, asking what would they be willing to, what interest rate they will be willing to charge a AA bank or company if they want to borrow for these 7 maturities. So what will be the rate for the overnight, what will be the rate for the 1 month, for the 6 months, for the 12 months, and so on. And after that, the BBA ranks these submissions, and it will so after ranking these submissions, it will eliminate the top 4 submissions and the bottom 4 submissions to ensure that there are no outliers that affect the calculation of the average. So if they have 18 banks, they will rank the ratings from the highest to the lowest. They will eliminate the top 4, eliminate the bottom 4, and then they will calculate the average based on the rest. And they will do this on a daily basis. Usually the LIBOR is published around 11 a.m. At the UK time. So that will be the rate for fixing on a particular day. Now, because of the allegations that the LIBOR could have been manipulated, now more and more people in the financial industry are moving toward a different rate, which we will learn later, because of the mistrust in the LIBOR. Now, in the past, the LIBOR was the major rate that the financial industry use as a reference. Now, because of these allegations of manipulations, a lot of people has lost faith or lost trust in the LIBOR, and they turn to use a different rate, which we will learn later. The next rate is the US, or not necessarily only the US, is the federal fund rate, or sometimes called the overnight rate. The overnight rate is also an unsecured borrowing between banks overnight. And this rate is used to cover the deficit in the company in the bank's account at the Federal Reserve or the central bank. Now, from the economics of money and banking, you know that banks must maintain a deposit with the central bank. This is used as a safety net in case there is a liquidity crisis. Now, every day there is a clearing among banks because of the deposits and withdrawals from one bank to another, and the clearing usually is done through the central bank. Now, as a result of this clearing, sometimes a bank's balance at the central bank is below the required reserve, and they have to deposit funds to bring it to the minimum level required. Otherwise, there will be huge penalties on the bank. So to cover the deficit or the shortage in their account at the central bank, they will borrow from another bank. Some banks might have a surplus, other banks will have a deficit. So they will negotiate, banks will negotiate between each other to borrow funds and cover their deficits. Now, there could be, for example, an agreement between Al-Inma Bank and Bank al-Riyadh for Al-Inma to borrow from Riyadh Bank to cover its deficit from at the central bank, and another transaction between SAB and Samba, for example, to cover their for SAB to cover its deficit with the central bank. So to calculate the effective federal fund rate, usually it is based on the weighted average or rate of the brokered transactions. it is possible that a broker can interfere and manage this process between banks. And also the federal or the Federal Reserve or the central bank will monitor these rates and might interfere if it found that the rate is deviating from a target they set for the variations of the fluctuations in the rate. And it will interfere by its own transactions to raise or lower the rate. So this is not only particular in the US. These are this is a standard in any economy where there is a central bank, and banks must maintain a reserve with the central bank. Now, it turns out that this rate will be a basis for an important trait that we will learn about after a few slides, because this is unlikely to be manipulated, unlike the LIBOR. In LIBOR, there was, at least before before 2007, 2008, there was no monitoring on how the rate is calculated and how or on the whole process. Now, more and more people in the financial industry are using the federal fund rate as a basis for what's called an overnight index swap. The overnight index swap, as we will learn later, is an important rate, and it is used as a proxy for the risk-free rate. Now, the three rates, the treasury rate, the LIBOR rate, the federal fund rates, are all considered unsecured rates. And by saying unsecured, it means that there are no collateral involved with the lending transaction. So here, for example, Anma Bank borrowed from Riyadh Bank, but the lending agreement is not based on there is no collateral to protect Riyadh Bank in case something happened to Anma and Anma was not able to pay back its loan. So when we say a rate is unsecured, it's based on an agreement between the two parties, the borrower and the lender, to borrow funds on an unsecured basis, which means that there will be no collateral involved to secure the loan. The last we'll cover here is the only rate that is considered as a secured borrowing, or a secured borrowing rate. The idea behind the repo rate is that the repurchase agreement is that it's an agreement where a financial institution owns a security and it agrees to sell the security for let's say X, and buy them back in the future, and usually this is the next day, at a slightly higher price, which is Y. Now, why will a company do this? Again, there might be a shortage of funds that the company require to cover some of the deficits it have with the central bank or with the other commitments. So to cover this deficit, it might go to the repo market and offer to sell a security for X and agree to pay it back at a slightly higher price, which is Y. Now, the rate of interest is calculated from the difference between X and Y, and it is known as the repo rate. Now, sometimes the party involved in the repo rate is the central bank. So we have here the central bank, and we have here a financial institution. So the financial institution will give or sell the asset at X, and it will buy it back at Y. This again is the repo rate. It is possible that a financial institution will buy from the central bank asset, let's say at Z, okay, and it will sell it back. Yes, it will sell it back to the central bank at a higher price, let's say A. In this case, this is called a reverse repo rate. In the repo rate, the financial institution will borrow funds by giving a security or selling a security to the central bank and buying the security at a higher price. In the reverse repo rate, the financial institution will lend to the central bank by buying an asset from the central bank and selling the asset at a higher price on the following day. Now, sometimes banks might have some excess funds, and instead of keeping this excess funds idle, they will try to generate an income out of it by engaging in a reverse repo rate. In Saudi Arabia here, we have a rate that is similar to the LIBOR, which is called SIBOR. Now, the SIBOR is the rate of interest at which Saudi banks offer to lend unsecured funds to other bank in Saudi riyals. It is available for 6 maturities and overnight, 1 week, 1 month, 3 months, 6 months, and 12 months. SAMA, or the central bank now, appointed Thomson Reuters to be the administrator of the SIBOR and the calculation agent. So every day, Thomson Reuters will ask banks for their quotes of lending another bank for these 6 maturities. Thomson Reuters will eliminate or exclude the highest 2 and the lowest 2 and calculate the average for each average rate or each SIBOR rate for each maturity, and that will be the rate fixing rate for that day. It's important to look at what is in our local economy. What are the rates that we have learned so far? So the repo rate is 1%, and it was changed in March 2020 as a result of the coronavirus pandemic and its effect on the economy, where in all economies they lowered interest rates to protect the economy and avoid entering into a recession. Now, the reverse repo rate is 0.5. The demand deposit reserve is 7%, and the saving deposit reserve requirement is 4%. These requirements were quite stable. The last time they were changed in 2008. repo rate and the reverse repo rate are adjusted from time to time. And these are the SIBOR rates for fixing date February 11th. So you can see here the overnight rate is 0.458. The 1 week SIBOR is 0.591, and you can see as the maturity increases, the SIBOR rate also increase, which is all what is expected in a normal market. Now, most swaps, which we will learn in chapter 7 and we'll discuss in chapter 7, and we are talking about interest rate swaps, are based on an agreement where LIBOR is exchanged for a fixed rate. And usually the swap is based on the 3-month LIBOR, and it's exchanged for a fixed rate that has the same risk for a certain number of times in the future. Now, since there is a movement away of the SIBOR, of the LIBOR, and a search for an alternative, people are now using the overnight index swap rate, or the OIS rate. Now, the OIS rate is based on the overnight rate or the federal fund rate. When it is the geometric average of this rate for a particular maturity, and usually, since the overnight rates are every day they are changing, the OIS also is continually refreshed. So today the OIS is something, tomorrow it's something different, based on what are the overnight rates for this day. Now, we know that, or we will see more and more throughout the course, that derivatives are valued by setting a riskless portfolio and are arguing that the return required on such a portfolio should be the risk-free rate. So if you want to value a derivative, we need to discount the cash flow expected out of this derivative using the risk-free rate. Now, here it comes an important question. Which rate among the rates we just learned we should use as a proxy for the risk-free rate? Should we use the treasury bills, which is usually what is standard textbooks refer to as a reference for the risk-free rate? What is the problem with using the treasury rates as a reference for the risk-free rate? Now, as an investor, I might be able to lend based on the treasury rates, but will I be able to borrow based on these rates? Well, the answer is no, because only the government can issue treasury instruments. So even the highest credit quality bank will not be able to lend at exactly the treasury instruments. So this means we cannot use the treasury instrument as a practical proxy for the risk-free rate. Okay, that's why in the financial industry, people use the LIBOR as a proxy for the risk-free rate. Now, when people start to distrust the LIBOR, they searched for an alternative, and the best alternative they found is the OIS rate. So moving forward, usually what we will use as a proxy for the risk-free rate is the OIS, or the overnight index swap. Okay. Next, we will turn to the topic of measuring interest rates. Now, the compounding frequency for an interest rate is its unit of measurement. What do we mean by this? Let's look at an annually compounded rate. What does it really mean? It means that if you invested today 100, and let's say the annual compounded rate is 10%, it means that you have to wait for 1 year to receive the interest of 10%, or the $10 based on the 100. So you receive the interest and you receive the principal back, which is 110. طيب, what is a semi-annually compounded rate means? Now again, if we have a 10% APR, usually this is how rates are described. They are an APR, an APR. It means an annualized percentage rate. When you see an APR rate or a quarterly rate, sorry, a quoted rate or a nominal rate, keep in mind that you cannot use this rate directly. You have to turn it into an effective rate to be able to use it to calculate interest, to discount, whatever. The only exception is when we are dealing with an annually compounded rate. 10% compounded semi-annually, it means that I have to wait for 6 months to receive interest, and the interest usually is based on the effective semi-annual rate, and the effective semi-annual rate is always the APR divided by how many times the rate is compounded in a year. Since I'm dealing with semi-annually compounded, it means that the rate is compounded twice, which means there will be 2 times in a year in which I will receive interest on the amount I deposited. So after 6 months, I will receive 105. And after another 6 months, I will receive, we'll receive 110.25. Why does this 25, or from where does this 25 comes from? It comes from the fact that we earned interest also on the principal, and we earned interest on the interest, which is the $5. So I deposit or I invest 100 today. I will receive the interest I earned plus the principal. I will reinvest them again, and I will receive interest on the principal and interest on the interest, which is the 5. So in total we will get 110.25. Again, let's look at let's increase the frequency of compounding in a year. So in an annual compounding case, the rate is compounded only once. In the semi-annually compounding case, the rate is compounded twice. In the quarterly compounded case, the rate is compounded 4 times. So again, if we are relying on a 10% quarterly compounded rate, the 10% is an APR, an annualized percentage rate, which means I cannot use it to calculate. If I did the following, I am investing 100, okay, and you said that I'm going to earn after 1 year, after 1 quarter, after 3 months, 110. That is completely wrong. Why? Because you assume that this is the effective quarterly rate, which is not the case. Rates, if you look at your credit card, for example, you will find that they will not state the effective rate, they will state the APR rate. And unfortunately, this is how it works. So to get the effective quarterly rate, I have to divide by 4. To get the effective semi-annual rate, I have to divide by 2. So investing 100, it means that after 3 months, I will get 102.5. Investing 102.5 for 3 months, it means we will get, so in 6 months we will get 105.625. After another 3 months, which means after 9 months, we will get 107.66891, and after another 3 months, which is after 1 year, we will get 110.38. So you notice that the effect of increasing the frequency of compounding means we will get, after the same period, a higher amount for what we are for our deposit or our investment. This is the effect of increasing the compounding frequency. Now we can continue this process. We look at, for example, monthly compounding. We could look at daily compounding. We could look at an hourly compounding, compounding every minute, compounding every second. We can increase the frequency of compounding until it becomes unlimited. So if at the limit, we will reach what's called a continuously compounded rate. In a continuously compounded rate, every millisecond there is an interest earned and reinvestment. So you cannot divide the frequency of compounding into a discrete or into intervals. It's a continuous process, and after 1 year, we will get for our investment a certain rate based on the way we calculate how continuously compounded rates are done. Okay. Right. Now, why we are discussing the frequency of compounding? Because it's important, first in finance in general, and also in this course, when we are using continuously compounding rates, I need you to understand or visualize or picture how a continuously compounding rate operates. Now, although we are dealing with different frequency of compounding, but this doesn't mean that when we are dealing with quarterly compounding and monthly compounding, for example, we are dealing with rates that measuring or different measurement units but they are measuring the same thing. It's like when we are measuring a distance using miles and using kilos, it will give us two different readings or two different numbers. Doesn't mean that the length of the distance is different. It means the way we measure them is different only. So when we compound m times per year at the rate r, and r is again an APR rate or a quoted rate or a nominal rate, which generally we do not use it directly to calculate interest payments or to discount. An amount A will grow to A times 1 plus R divided by M, all to the power of M. And by doing this, by dividing R over M, we are converting the APR rate into an effective rate, which we can use to calculate how much interest we will receive, how much when we want to discount a number or an amount, we will be able to discount it or compound it using the effective rate. As an illustration to a continuation to the example we did before, if we compound, if the frequency of compounding is monthly, so which means we compound the interest payments 12 times in a year, then the value of 100 invested today will grow to 110.47, and you can see the effect of receiving the interest early and earning interest on interest leads to receiving a higher amount at the end of 1 year. Now, I introduced in chapter 5 the idea behind continuous compounding and how we can find the value of a certain amount in the future if compounded continuously. So again here, if we are dealing with a continuously compounded rate, which means that the frequency of compounding is continuous, it's a continuous process, we cannot divide them into intervals, then 100 will grow to a value that is 100 times e to the power of RT. So in other words, if I want to find the future value of a certain amount, the future value is equal to the present value times e to the power of RT. And again, E is the Euler number, which I introduced in chapter 5, and R is the continuously compounded rate, and T is the number of years. So it's the period in which we are trying to find the future value expressed in terms of years. If I have an amount that I will receive in the future and I want to find its present value, the present value is equal to the future value times e to the power of minus RT. So when we are compounding using a continuously compounded rate, we rely on this formula, and if we are discounting, we rely on this formula. Now, sometimes we need to convert a rate that is continuously compounded into a rate that is compounded in a discrete manner. For example, compounded annually, compounded quarterly, compounded semi-annually. How can we do this? There's a formula that will enable us to do this conversion. If I have a rate that is discretely compounded, so it's not continuous, or a discrete rate, and I want to find the continuously compounded rate, I use this formula. what this formula tells us, it tells us that the continuously compounded rate in a year, so always the continuous compounding is expressed in terms of years, is equal to M, which is the frequency of compounding, okay, plus times ln of 1 plus Rm, the discrete rate, divided by M. Again, here I'm using a rate that is an APR rate, annualized percentage rate, or a rate that is nominal, or the quoted rate, which means the rate that I cannot use directly to calculate interest payments or to discount with that rate. Now, if I have the effective rate, then I don't need to use this. I just add 1 plus the effective rate, and I need to put here M is how many times this rate is compounded in a year. Now, if I have a continuously compounded rate and I want to find the discrete rate that is equivalent to this continuous rate, then I can convert it using this formula, which tells me that the discrete rate, let's assume I want the rate that is semi-annually compounded, an APR rate that is semi-annually compounded. So this rate will, to get this rate out of a continuously compounded rate, we multiply M by how many times the rate I'm targeting is going to be compounded, times e to the power of the continuously compounded rate divided by M, this whole number minus 1. Let's take an example. 10% with semi-annual compounding is equivalent to what continuously compounded rate? So using the formula, we will get RC is equal to M times ln, the natural logarithm of 1 plus Rm divided by M. So if we want to translate this, we will have 2 times ln ln of 1 plus 10% divided by 2 will give me 5%. 1 plus 0.5. We take the ln of 1.0.5 times 2. We will get the equivalent rate with continuous compounding is this. Now, let's assume I have an 8% with continuous compounding, and I want to find, let's say, the quarterly rate. Okay, so to get the quarterly rate, we need to use the formula for converting from continuous into a discrete rate, which is Rm is equal to M times e to the power of Rc divided by M minus 1. So the quarterly compounded rate is compounded 4 times in a year, and Rc is 8%. So 4 times e to the power of 0.08 divided by 4 minus 1 will give me 8.08% with quarterly compounding. So an 8% with continuous compounding is equivalent to 8.08% with quarterly compounding. Now, why we are learning continuously compounding rates? Are they do they make sense? Are they practical? Now, the continuously compounded rate will provide a number that is very close to daily compounding. So in a way, it is not totally impractical. Second, why we are using these rates is because the theory on which most of the derivatives are based on assumes that rates are continuously compounding. So that's why to make it easy to map whatever is in the theory into practice, we use continuously compounded rates. We next turn to the different types of rates that we will observe in the market, and it has applications in when we are dealing with fixed income securities. So the first rate is called the zero rate, and the zero rate we obtain it from or we get it or we calculate it from debt instruments like treasury bills that pays no coupons. Now, in terms of the types of debt securities or debt instruments, there are different names for each type of debt based on the horizon of the maturity. If the maturity of the debt security is 1 year or less, usually it's called bills. So if we are dealing with treasury securities issued by the government, we call them treasury bills. If the maturity is medium term, usually they call them treasury or corporate bonds or notes, corporate notes or treasury notes. And usually the maturity is less than 5 years but higher than 1 year. And if the maturity is higher than 5 years, then they are called bonds. So treasury bonds, corporate bonds, and so on. Now, zero rates are important because we will use them later on for different functions. Let's first understand the idea behind the zero rate, then we will see how we can use it. Again, a zero rate, or sometimes called a zero coupon rate or a spot rate even, is the rate of interest earned in an investment that provides a payoff only at time t. So let's say, for example, a zero rate for maturity 6 months. It is the interest you earn from investing in a treasury bill that will pay off only after 6 months. We know that treasury bills, they don't pay coupons. Investors invest in these or buy these bills at a discount and wait until they mature and they receive the face value of the bill or the bond. طيب. For example, we are dealing with a 6 months treasury bill that is issued at 97.53, and at maturity the holder will receive or will get 100. So if we want to determine what is the 6 months zero rate, we using the prices we observed and applying the formula that we learned about discounting or compounding, continuously compounded rate, we know that the future value is equal to the present value times e to the power of minus RT. So if I have the future value, which is 100, and I have the value, which is 97.53, and I know that t is equal to 0.5 because I'm looking at the 6 months treasury bill, I can easily calculate R. So I have to do some rearrangement. So this is equivalent to the future value divided by the present value. I divide both sides by the present value, and we will get this is equal to e to the power of rt. Now the problem that r, which is unknown for us, is the exponent of the Euler number. So to get rid of this problem, I will take ln of both sides, which means ln of the future value divided by the present value is equal to ln of e to the power of rt. Now from basic math we know that if a number, if we take a logarithm of a number that is raised to a power, we can take this power out and multiply it by ln of e. So this means ln the future value divided by the present value is equal to r times t times ln of e. And we know from math that ln of e is equal to 1. So this will leave us with the formula. If we divide both sides by t, we will get r is equal to ln of the future value divided by the present value, all divided by t. Now applying this formula to get the zero rate for 6 months, we will find that the zero rate is equal to 5% with continuous compounding. So all what we need to do here, if we want to apply the formula, we take this is equal to ln of 100 divided by 97.53 divided by 0.5, because t is 6 months, which is a half of a year, and we will get this is equal to 0.05 or 5%. Now if we want to let's assume that we did the same process on on treasury instruments that mature for after a year and a half, and after 2 years, and we found that the zero rates are as we see here, 5, 5.8, 6.4, 6.8, and so on. طيب, now why do we need these rates? Now let's assume I want to find the price of a bond that matures after 2 years and pays coupon payments every 6 months. Or in another word, it pays 6%. No, it has a coupon rate that is equal to 6% payable semi-annually. So to calculate the price of the bond, what do we need to do? What are the 3 major steps in finding or determining or valuing any security or any project or any asset? We first estimate the future cash flows. We second determine the proper discount rates, and we third discount the cash flows using discount rates and find their present value, and we add them together. It's better always when we are dealing with securities, assets, whatever that we are trying to value, it's to visualize how when the cash flows will take place, and how then we are going to deal with these cash flows. So this bond pays 6% coupon rate, and since they are the coupons are paid semi-annually, then half of the 6% will be paid every 6 months. After 6 months from now, the bond will pay $3. After 1 year, it will pay $3. After a year and a half, also it will pay $3. And after 2 years, how much we are going to receive? So after 2 years, the bond is going to mature. Exactly, we will receive the face value, which is 100, plus the interest or the last coupon payment, which is 103. Now, we determined what are the future cash flows for this bond. We know the timing when they will take place. Next, we need to determine what is the proper rate to discount these cash flows. Now, it is possible that in prior courses, you learned that you can use one rate to discount all these cash flows and find the present value or the price of the bond, which is not totally accurate, because if you use a single rate that you observe in the market, you assume that the term structure of interest rate is flat. And by the term structure, we mean how the interest rate change with the maturity of the debt instrument. And rarely we see the term structure of interest rate are flat, which we will also discuss shortly. So a better approach is that for each cash flow, we look at what is the appropriate rate to use as a discount. So here we turn to the market. We found the zero rates are 5% for a maturity of 6 months. So I will use this to discount the first coupon payment. The second coupon payment, I will use 5.8 to discount it, because it is the appropriate rate. It will mature after 1 year. And after a year and a half, 6.4, and after 2 years, 6.8. So again, here we will have 5%. So I'll discount using the 5%. And here I will use my 5.8%. Double check. Yes. And then the 6.4. And then I will discount the 103 using the 6.8%. Now, remember, we calculate the zero rates assuming that or using the continuously compounded formula to find the future value or present value. So the nature of the rate that we got is continuously compounded. Next, if I want to determine the price of the bond, we'll use the rates we observed early. So 3 times e to the power of minus 0.05 times a half. This is t, and this is the first zero rate, R1. The second coupon payment, we will discount it using 0.058 times 1. T is equal to 1, and the discount rate we will use is 0.58, because this is the zero rate for maturity of 1 year. Third rate is similar, 3 times e to the power of minus 6.4% times 1.5. And finally, the face value and the last coupon payment, we will discount it using the 6.8% zero rate that we found for a maturity of 2 years. So if you did this, we will get the price of the bond is equal to 98.39. Okay, now it is possible that in the financial press you will not see the price of the bond. Instead, you will see the bond yield. So the bond yield is the single rate that makes the future value or the present value of all coupon payments, including the face value, equal to the price we observe in the market. So in other words, it is the rate that makes the present value of all coupon payments plus the face value equal to the price we found in the market or we calculated earlier. And why the yield to maturity or the bond yield is used? Because it makes comparison between different bonds much meaningful, because you cannot compare bonds by purely looking at their prices, because a bond with a longer maturity is expected to yield or to have a higher price, but doesn't mean that you will earn a higher return by investing in this bond. So that's why in the financial market, in the financial industry, in general, people use bond yields or the yield to maturity to express or to characterize a bond. Now, how can we get the bond yield if we know that this is the formula to find the yield? Unfortunately, we cannot solve it algebraically because y is an exponent to more than one component of the formula here. So we need to use a trial and error, or sometimes we need to use some optimization function like the solver in Excel to try to search for the number that makes the present value of these cash flows equal to the price you observe in the market. So solving or trying to get the value of y, we find that y is 6.76%. So we learned about the zero rates, we learned about the bond yield. Now we learn about the par yield. The par yield is basically the rate that makes it's the coupon rate that makes the bond price equal to its face value. In other words, it makes the bond will be issued at par value. Why it is important? Because if we know that currently the zero rates are what we observe in the market, and we want to determine what coupon rate should we offer for a bond to make the issuance price equal to its par value. So how if we offered a higher rate relative to what we are supposed to issue, then we are paying more interest expenses than we should, and no company wants to pay more expenses for no reason. And if we offered a lower coupon rate than we should, based on the risk level, based on the economic conditions, we might not be able to successfully sell all the bond issuance. So that's why people involved in bond issuance, they need to carefully determine the appropriate coupon rate that they should offer on the bond they want to issue. So in the example we were dealing with, we know that the zero rates are the rates we observed a few slides ago. and this is the face value, and we are trying to get what is the coupon rate that will make the present value of these payments equal to 100. Now one might ask, why did we divide by 2? Because I want to get the nominal coupon rate or the annualized coupon rate, because the coupon rate, like in the example we saw early here, the 6% coupon rate, that's the annual coupon rate, but every 6 months the bondholder will not receive 6% of the face value. He will receive 3%, because in a year he will receive 6%, but since the coupons are paid semi-annually, so he will receive half of that every 6 months. So that's why here we divided by 2 to give us the face or the annual coupon rate that we should set for our bond when we issue. And we will find that the coupon rate should be 6.87%, and that's in an annual basis. Now every 6 months, how much the company has to pay to its bondholders will be half this amount. There is another way to determine the par yield, which is using this formula. It makes our life much a bit easier compared to the previous example. This formula states that the coupon rate is equal to 100 minus 100 times D, and all what's inside the bracket times M, and the whole numerator is divided by A. Okay, what is D, what is M, and what is A? D is the present value of $1 received at the maturity. So in our case, to find D, D is equal to E to the power of minus 0.068 times. So it is as if we discounted $1 for 2 years using the 2-year zero rate. M is how many times there will be coupon payments per year, which is 2 in our case. And A is the present value of an annuity of $1 received on each coupon date. So in our case, this is equivalent to, so we have $1 here, $1 here, $1 here, and finally $1 here. And the first one will be after 6 months, after 1 year, after a year and a half, and after 2 years. So we need to find the present value of this annuity. We will get, or we will do A to the power of minus 0.05 times 0.5 plus E to the power of minus 0.058 times 1 okay, plus E to the power of minus 0.064 times 1.5. Finally, E times minus 0.068 times 2. So we calculated A, we calculated D, and we know what is M, and we use this formula. It will give us what will be the coupon rate, which we will find is equal to, again, 6.87. Okay, Now we turn to the issue of finding the zero rates. In the previous example, we assumed that we can observe a zero coupon bond with a maturity of 1.5 years, with a maturity of 2 years. And we know that there are no bills or treasury instruments that are a zero coupon with maturity longer than 1 year. So here we are going to face the issue of how can I get the zero rates for maturities longer than 1 year. So we will use a process called bootstrapping. So we will bootstrap the zero rates given some data or some information we know about the other zero rates. Now let's start with the finding the zero rates for maturity of 3 months, for maturity 6 months, and for maturity 1 year. These turn to be easier to find because there are no coupon payments in these maturities. All what we need to know is that to find the zero rate, and based on the formula that we derived earlier, R is equal to ln of the future value, which is the bond principal, divided by the present value, which is the bond price that we observe for each maturity date, divided by T. So if we apply this for the 3 month zero rate, we will get the 3 month zero rate is 1.603. Again, we are dealing with rates that are continuously compounded. We follow the same process for the 6 months, and for the 1 year we will find that the 6 months is 2.01 and the 1 year is 2.225%, all again with continuous compounding. Next, I want to determine the 1.5 year zero rate. What do we have? We have now, we found the zero rates for the period of 3 months, 6 months, 1 year, and I want to find the zero rate for a maturity of 1.5 years. The problem is I don't observe a zero rate directly in the market because there are no bills that have a maturity longer than 1 year. Instead, what do I observe? I observe that there is a bond that matures after 1.5 years or a year and a half, but this bond pays coupons semi-annually. So and this is the annual coupon payment. So every 6 months the bond will pay to its holders what? Since half of the stated coupon is paid each semi-annual or each 6 months, not each year, $2 will be paid after 6 months, $2 will be paid after 1 year, and $2 plus the principal will be paid after a year and a half. So what do we know about the bond that matures after a year and a half? We know that the first payment will be paid in 6 months, which is coupon payment in 6 months, which is $. So this amount will be discounted using the zero rate that we found with maturity 6 months, which turns to be 1.603%. Okay. Now, the second coupon payment is going to be discounted using the 1 year zero rate, which we found in the previous example on previous slide, which equals to 2.01%. Now, what we are left with, we need to discount the 102 using the zero rate that has a maturity of 1.5 years. And do we know this rate? The answer is no. We are trying to find this rate. Okay. What other piece of information that will help us to find this rate? We know that the present value of this bond, or the price of this bond we observe in the market, is 102.5. From the table here, the price is what? 102.5. So we want to find the present value. This is the present value of the coupon payments plus the face value that the bond will pay during the next year and a half. Okay, will this help me find the 1.5 zero rate, 1.5 years zero rate? Let's see. 102.5, the price is equal to 2 times e to the power of minus 0.01603 times a half. So we discounted the first coupon rate, coupon payment using the first zero rate that we found earlier. Second, plus 2 times e, just a correction, this rate is for the 3 month, which is not correct. We don't want to use the 3 month zero rate, we want to use the 6 month zero rate, and the 6 month zero rate is 2.01%. So again, also here that's not correct, just a quick correction. So this is 2.01%. And this is 2.225%. So we discount the first rate using the 0.201, and the second the second coupon payment, we will discount it using this minus 0.02225 times 1 plus 102.5 times e to the power of minus r, which we don't know, times 1.5. Now, organizing the formula to find the present value of the coupon payments this way lead us to have only one unknown number, which we can solve to find what will be the 1.5 years zero rate. So we will try to infer the 1.5 year zero rate using a bond that matures after a year and a half, and relying on the zero rates that we observe for maturities lower than 1 year. So this will reduce to we calculate the value of this part of the equation, and we calculate the value of this part of the equation. We take them to the other side. So we will deduct 102.5 minus the value of this number and the value of this number. We will get 98.564 is equal to 102.5 times e to the power of minus 1.5 r. This is, we follow the same process as we did in previous rates. So we divide both sides by 102.5, so we get here a fraction is equal to 102.5 times e to the power of minus 1.5 r. Since r is the unknown, which is the unknown is the exponent of e, to get rid of this we take ln of both sides. So we have ln here and ln here, ln of this value, and we turn out to reduce the formula to become so r is equal to ln of the price divided by the future value, all divided by minus 1.5. This will lead us to a zero rate with maturity of 1.5 years is equal to 2.284%. Okay, so we have now the zero rate for 6 months, the zero rate for 1 year. Using the bootstrapping method, we get that r for the zero rate for the period of 1.5 years is 2.284%. Next, we found the zero rate for 6 months, for 3 months, for 6 months, for a year, for 1.5 years. Now we need to find the zero rate for the period of 2 years. Again, what is the problem? The problem is we don't observe in the market an instrument or a zero coupon instrument or a zero coupon bond or bill with the maturity of 2 years. We only observe a bond or note that pays coupons every 6 months and matures after 2 years. And what we know about it is that it has a price today of 105 and it pays every 6 months 2.5, since 5 is the coupon rate for this bond. So to find the price of this bond, the zero rate for this bond, we follow the same process that we did with the 1.5 years, and we will find that the 2-year rate is 2.416%. I advise you to follow the same process on the 2-year bond and verify that the zero rate for a maturity of 2 years is 2.4516%. Now, after doing this, we construct the zero curve or the term structure of the zero rates, and we will find that it's an upward sloping. Now, in a normal setting, if the economy is doing well, the conditions of the economy is there is a growth in the economy, people are optimistic about the outcome of the economy, then we will always observe an upward sloping zero rate curve. When the economic conditions are not good when the economy is about to enter into a recession. We will observe that the term structure of interest rate is downward sloping. In fact, investors on a daily basis, they monitor the term structure of interest rates because there has been evidence, very strong evidence, that when the term structure becomes inverted, which means it's downward sloping, it predicts that there is going to be a recession soon. Okay. So to make the what we learned relevant to the real life, this is the term structure of the treasury yields on debt instruments issued by the Department of Treasury, the U.S. Department of Treasury. They issue instruments that mature in 1 month, 2 months, 3 months, 6 months, and 1 year. So these are the bills. They also issue a 2 and 3 and 5 treasury notes, which have a medium term expiration or maturity, and they also issue a 7, 10, 20, and 30 years treasury instruments. So what do we observe here in this graph? And that was the beginning of the pandemic, when it started to when the World Trade when the World Health Organization declared the coronavirus a pandemic. There has been a huge uncertainty in the market, and people rushed into medium-term instruments more than short-term instruments, and because of that, we observed that the structure of the interest rate is, at the beginning, it was downward sloping, then it was upward sloping. Now, if it was continue to decrease, if the yield continue to decrease as the maturity increases, then that was a strong signal that the U.S. economy will enter into a recession. Now, about 2 weeks after, when we observed this term structure, we found that the term structure returned back to its normal the normal shape, which is an upward sloping. In the class, we will discuss with you how these rates are determined and why these medium terms treasuries have a lower yield compared to the shorter term treasuries. This also is the term structure or of the treasury yields before the start of the financial crisis that took place in 2007. And see, it has a very weird shape. For short maturities, there was a lower yield, then the yield required increase, then it decreased, and then start to increase again. To make also this the idea a bit relevant to our local economy, these are the rates issued by the Saudi government. The Saudi government doesn't issue treasury instruments on a daily basis, but they issue them on a predetermined schedule. So we observe here that the rates issued 2 days ago were at, so that's the curve of the treasury treasury yields issued by the Saudi government about 2 days ago, and which we find that they decreased, okay, to 1 month ago, and they are also lower than what was the treasury bonds, treasury yields on July of last year. So it's interesting to see how these rates evolve over time, and we also discuss why these rates are different from each other at different points in time.